Hello, this is Victor Cuevas with Victor for Advice, and this is a two-part video series that's really geared towards self-employed and small business owners. Now, anybody can benefit with what I'm going to talk about, but small business people and self-employed people especially will benefit. And here's the reason why. Most self-employed and small business owners don't save for retirement in their early years. It's just building the business. Sometimes things fail. Sometimes they got to rearrange things, but they got to continue to build the business. Anything they have left over that isn't for lifestyle and taking care of the family, they're going to put it right back into the business. So they go on like that, and next thing you know, you're 40, 50 years old, and you haven't saved anything for retirement. Or it could be that you had an old 401k when you were in your 20s, and then you went self-employed, or you started a business, and now you haven't contributed for the last 20 years, and now you're trying to catch up. So when you go to your CPA and you say, look, I want to start a retirement plan, what do you suggest? And the CPA, being a very conventional kind of person, and also being the person that wants to be your hero when it comes to your taxes, the only thing he's going to recommend you is something that's going to save you on taxes and put more money in your pocket, or allow you to keep more of what you earn and use it for what you want to, and some of it's going to go into your retirement plan. And so conventionally, that's the right thing to suggest. But I'm going to ask you to be open-minded and to use your common sense, because personally, I don't think that's the best way to save for retirement. By that I mean putting your money in a quote-unquote qualified plan that allows you to deduct your entire contribution against your taxes. That may not be the best way to go with your money, or at least not all your money. You want to keep some out and put it in the stock market on a tax qualified basis. That's fine. I can argue that keeping it, if you want to put your money in the stock market, putting it into a brokerage account that's not qualified would be a better way to go, but that's another video. So I want you to think about something. Saving taxes when you contribute is fine. But I want you to realize that one of these days you're going to start drawing that income for retirement to live off of. And you want that nest egg of yours to last for 20, 30 years, to carry you through a long retirement, an enjoyable retirement, and a retirement where you'll have some money to enjoy a good quality of life. The only problem is that you will be paying far more in taxes on your retirement nest egg than you ever saved while you were accumulating it. You see, the CPA is going to want to hammer into your head, we've got to save you on taxes. If you're going to contribute to your retirement plan, might as well not pay taxes on that income, on that income that you're diverting into a retirement plan. The only problem with thinking that way is that you will pay taxes on income someday. And when you're in retirement, is the last time, that is not when you want to be paying a bunch of money into taxes. See, while you're young and you're hustling and you're building that business, and even after you've plateaued and you've got it going well and you're enjoying the benefits of your hard work, you can afford not to pay, not to save those taxes on what you put in. Because if you put $50,000 a year into retirement and you save $10,000 a year, and you're making $150,000, $200,000, $250,000 or more, you can afford that $10,000. But when you retire and you're making far less than that, and your deductions are less, you're being taxed on all of your income at that point with no deductions or far fewer deductions. And the amount of taxes that you pay in retirement are going to be far greater than whatever you saved while you were contributing to that nest egg. And that's what I want you to think about, that concept right there that I just explained. I want you to think about that. And in the next video, I will break it down and I will show you the numbers. And when you see it, it will make perfect sense. And then I want you to consider not putting all of your nest egg money, or maybe even none of it, in a tax qualified plan just to save some taxes during your working years. Maybe not the best thing to do. So I encourage you to go on to the next video and check it out, and then get back with me and let's talk about the strategies that I use for the self-employed and for small business people. And it might be just what you need to do. This is Victor Cuevas with Victor for Advice. God bless, and I hope to be talking to you soon.